Welcome to another episode of Deep Dive on NewsX. A single earnings report from an American technology giant has sent shockwaves across the Wall Street. India's IT sector witnessed a full-scale bloodbath today, with every major technology stock ending deep in the red. From TCS and Infosys to Tech, Wipro, Tech Mahindra, and LTI-Mindtree, investors rushed for the exits, erasing massive amounts of market value in just a few hours. But what exactly happened? Let's break that down. The trigger for today's crash was the latest earnings report from global technology consulting giant Accenture. At first glance, the numbers looked respectable. Revenue growth remained positive and profits were largely in line with expectations. But markets don't just react to what happened in the last quarter, they react to what companies say about the future. And that is where investors got worried. Accenture lowered the upper end of its annual growth forecast and warned that clients remain cautious when it comes to spending on large technology projects. The company also pointed to delays in decision making and uncertainty in several global markets. In simple terms, the message was this: businesses around the world are still hesitant to spend aggressively on technology services. That statement immediately set off alarm bells for investors tracking Indian IT stocks. Why? Because India's IT giants and Accenture serve many of the same clients. Whether it's banks in North America, healthcare companies in Europe, manufacturers in Asia, or telecom giants across the world, the customer base often overlaps. So when Accenture says demand is slowing, investors assume Indian companies could soon face the same challenges. And that assumption triggered today's sell-off. As soon as markets opened, technology stocks came under heavy pressure. Infosys was among the biggest losers, falling sharply during the session. The stock fell by 6.5% on closing bell today, falling 73.3 points. TCS, India's largest IT company, also witnessed significant selling. The stock fell 3.06% and closed 67.4 points. Tech, Wipro, Tech Mahindra, LTI-Mindtree, Coforge, Persistent Systems, Infosys, and Oracle Financial Services all joined the decline. By the closing bell, not a single major IT stock had escaped the carnage. The Nifty IT index itself plunged dramatically, almost hitting a 52-week low. The damage wasn't restricted to technology counters alone. The weakness quickly spread across the broader market. The Sensex closed around the 76,800 mark, while the Nifty slipped below the psychologically important 24,000 level. The fall snapped the momentum that Indian markets had been building over recent sessions. 1.3 lakh crore rupees lost. 1,500 stocks declining on NSE. The total valuation of all BSE Sensex company dropped from rupees 4.77 lakh crore to 4.76.38 lakh crore in just 2 hours. Now, to understand why the reaction was so severe, we need to look at the larger picture. For more than 2 decades, India's IT sector has been one of the country's biggest growth stories. The industry generates hundreds of billions of dollars in revenue and employs millions of professionals. However, over the last 2 years, the sector has faced multiple challenges. Global economic uncertainty has forced companies to cut discretionary spending. Many clients have postponed digital transformation projects, and now the rapid rise of artificial intelligence has introduced an entirely new layer of uncertainty. Investors are asking whether AI will create new opportunities or reduce demand for traditional outsourcing services. Accenture's cautious outlook has reignited all those concerns. In fact, analysts say today's market reaction wasn't just about one earnings report. It was about the fear that the global technology spending recovery may take much longer than expected. What's particularly interesting is that this is not the first time a single company's forecast has shaken an entire sector. Back in 2024, Accenture itself triggered a similar sell-off when it lowered its growth expectations and warned of weaker consulting demand. Indian IT stocks fell sharply on that occasion as well. Another example came from Nvidia during the AI boom. Whenever investors worried that AI spending could slow, technology stocks around the world faced pressure. Markets viewed Nvidia's outlook as a proxy for the health of the broader technology system. A third example came from the banking sector in the United States in 2023 when Silicon Valley Bank collapsed. Investors didn't just sell that stock, they sold banking shares across the world, fearing systemic risks throughout the sector. That's how markets work. But here's the important question. Should investors panic? Well, not necessarily. While today's fall was severe, many analysts believe the long-term fundamentals of Indian IT remain intact. Companies such as TCS, Infosys and HCL Tech continue to believe that they have strong balance sheets, global delivery networks and deep relationships with multinational clients. Artificial intelligence may disrupt some traditional business models, but it could also create entirely new revenue opportunities. The challenge for investors is determining which outcome would dominate over the next few years. The big takeaway is simple. This wasn't merely a reaction to one company's earnings report. It was a reflection of growing investor anxiety about the future of technology spending, the impact of AI, and the strength of the global economy. And until those concerns ease, volatility in IT stocks is likely to remain high. Let's in fact get in a broader expert perspective on this from managing partner of Talk the Walk LLP, Sanchita Mukherjee, who is joining us. Sanchita, help us explain this plunge in the markets in IT stocks better.
Thank you so much for having me over here. Yes, you're quite right. You've summed it up really beautifully. But I would say that yes, I do not see this as a strategic crisis at all. I see this as a digital transformation. I see this as a transient digital transformation leading to a decline which has happened with a lower guidance given by a big tech bellwether company. Having said that, yes, this sector is all about hits and misses currently in the face of AI disruptions, increased competition, possibly lower discretionary spending in technology, especially by developed markets, the geopolitics of it, all of that, they do add up, the GCC trends, everything. So when I say hits and misses, yes, certain large cap heavyweight stocks have corrected to their historical averages in today's decline. But having said that, if you were to see the mid cap indices, a lot of the mid and small caps have actually ended positive in today's date. So mid-cap IT companies too are showing tremendous resilience. In fact, they have strategic engineering contracts. They are using digital opportunities, AI-led opportunities to come up with quite a fighting bet, if I may add. So that is definitely there. Given the larger scape of where we are headed in the world today, in this IT scape, I think one very pertinent question would also be to ask whether the AI-led hype, which is there in the developed markets and in markets like Taiwan, etc., is that a bubble as well? Are they actually contributing to the ROI of the companies there, to the ROI, the EPS of the share market over there, or is it actually right now trading in a bubble territory? In which case, it is a net positive for India because India has a very, very diversified sectors, almost close to 32 to 40 diversified sectors led by manufacturing, engineering, infrastructure, energy, all of that.
Sanchita, thank you very much for joining us. That's all I have time for in this discussion, but it was great to hear from you on that. And viewers, with that, let's take a very quick commercial break. We'll be back in a minute.